Good afternoon, everyone. It's Monday, the 5th of August. Welcome to another show of Monday Market Picks. My name is Thilan Wickramasinghe. I'm the head of research for Singapore at Maybank Securities. There's a lot of fear going around, lots of red on the screens, gripping the markets as a signs of the US economy cooling down, as well as escalating tensions in the Middle East. You've got to keep calm during times like this, because when there's fear, that's when opportunities are made. So today, our show, we're really going to be looking at some rotational trades that can benefit if you actually have rates coming off, particularly as a Fed response to some of the slowing US economic conditions. On that, first off, we have Desmond Ching, who's going to be talking about Malaysian banks. He thinks that there are potential winners, especially if rates start to come off. We have Gia Lin also joining us. She's highlighting AIM's APAC REIT, which is seeing some strengthening resilience. And we got Eric, who's highlighting SIA's results following a fairly disappointing performance and where we go from there. Finally, we've got some market moves as well in terms of technical buys as well as a technical sell. So do stay till the end of the show. In terms of overall market movers, I think there's no surprises here. All reds last week. Markets were on a sell everything mode given the weak US job numbers, pointing that the economy there might be cooling a little bit faster than expected. A lot of the frothier markets like the Nasdaq as well as the Nikkei were beaten the worst. An interesting thing that we noted was some of the more underheld markets like Malaysia as well as Jakarta actually held up a little bit better as the stock rout happened. So something to watch out for as we go into this week as well. Now, let's get to stocks. Let's talk to Desmond. Desmond, welcome to the show.
Yeah, hi, Dylan. Morning.
Good to see you. So now, if you look at the Singapore banks, which have reported so far, both UOB and OCBC, they've actually reported some pretty disappointing net interest margins coming off, and it looks like earnings are topping out for the Singapore banks. Now, in contrast, Desmond, you're actually reiterating your positive call on the Malaysian banks. What are some of the key drivers that is giving you this confidence at this stage, Desmond?
All right. So there are several factors that are contributing to that positive outlook, actually. Firstly, if you take a look at Malaysia's macro picture, it's looking conducive as a whole for the country. FDI flows have been encouraging, and Malaysia's GDP is forecast to grow at a rate of about 4.7% this year and picking up pace to about 5.1% in 2025. Secondly, there is growing talks of imminent interest rate cuts in the US. And our economics team is looking at 2 rate cuts this year, totaling 50 basis points, and 4 rate cuts next year of about 100 basis points in the US. But one thing to note is that Bank Negara paused Malaysia's rate hikes much earlier than the US. And so at the moment, our overnight policy rate stands at 3%. So against a Fed fund rate of 5.25 to 5.5%, there is a very wide gap of up to 250 basis points. As such, we are of the opinion that even if the Federal Reserve were to cut US interest rates, Malaysia is unlikely to move on our domestic rates, and we forecast the OPR to remain stable at 3% this year and next. So the implication here is that on a relative basis to regional countries that would likely have to cut their interest rates, we think that bank margins in Malaysia are likely to hold up much better than that of its regional peers. And another point is that with the strengthening of the ringgit, bond yields have been declining and will likely continue to decline. For instance, our fixed income team expects the 10-year MGS yields to move down further to, say, around 3.6% end of this year from 3.7% currently. And the rise in bond prices could therefore contribute to market gains for the banking sector, while the volatility in currencies bodes well for banks' forex income. Another point to note also is that the valuations for Malaysian banks are not demanding. the banking sector is generally trading at -1 standard deviation to mean on a forward PR basis. Moreover, your dividend yields are still attractive, averaging about 5.4% this year. So putting it all together, we do think that there are quite a few positives for the Malaysian sector as a whole, banking sector as a whole.
Yeah, absolutely. So, I mean, those dividend yields quite attractive, especially if you have global rates coming off. You've got margins actually holding up quite well, and the Malaysian economy itself doing quite well as well. So, Desmond, and one of the points you mentioned was that, overall valuations are quite cheap. How has foreign flows been to the banking sector so far this year?
Yeah, so foreigners have actually been net sellers on Malaysian banks for several years now. And in fact, the foreign shareholding levels on quite a few banks are close to their historical troughs. And this year, this scenario, what is positive this year so far is that we have seen selective nibbling on counters such as CIMB, a little bit on AMMB, Maybank. So, but we would expect the flows to be stronger, given that the currency is expected to strengthen and fundamentals of the banking sector are still intact. So, overall, we're actually hoping to see more foreign inflows into the banking sector.
Right. Okay. So the foreigners could be coming back as well. In terms of your top picks, Desmond, what are you keenest about at this stage?
So our top three picks would be firstly AMMB, followed by CIMB, and then Alliance Bank. In the case of AMMB, it's more to do with valuations. The stock currently trades at a price to book of about 0.7 times currently, for returns on equity of about 9+%, which we think would be unjustified at this stage, coupled with the fact that the bank itself is expected to raise its dividend payout ratio in the near future. So currently, the yield on the stock is currently about 5.7%. We are hoping that it moves up to 6% or more by the end of their financial year, which is March, on the back of higher dividend payouts. CIB has really outperformed this year and even last year itself. Well, a little bit more pullback would certainly justify getting back into the stock, given that the outlook for the stock is still positive as a whole. And thirdly, for Alliance Bank, it's the smallest bank in the universe. But essentially, again, from a valuations point of view, we feel that current valuations are unjustified. The bank focuses mainly on the SME segment, and growth this year is expected to be fairly decent. So on the whole, these would be the three stocks that we're promoting right now.
Right, excellent. So AMMB, CIMB, and Alliance Bank. So investors do take a look at that, and also Desmond's report is available in our newsletter today. So do have a look at that. Thanks, Desmond, for joining.
Thank you.
Now let's move on to the Singapore REITs and have Jia Lin join us today. She's got a buy call on AIM's APAC REIT. Jia Lin, welcome to the show.
Yeah, hi Dylan. Thanks for having me today.
Hi. So, Jia-Lin, AIM's APAC REIT announced two asset enhancement initiatives that will result actually in some rental downtime. But you still have the stock as a buy. Why is that?
Yeah, so maybe just let me give a quick refresher for the two proposed asset enhancements. The first one will be at 7 Clementi Loop. A global storage and information management company will start a 15-year master lease at this asset in first Q FY26. And AAREIT has also secured an anchor tenant at 15 Tyson Drive, which will start its lease around the October quarter this year and contribute to the second half of this financial year. So now we obviously like the two AIs for a few reasons. First, I think pre-commitment is very important in today's market. As we see in the industrial leasing space, it does take time for new developments development projects to ramp up, sometimes taking a few quarters. So having these two master tenant and anchor tenant really help AAREIT to de-risk the projected cash flow. And total cost outlay is less than 32 million with NPI yield projected above 7%. I have to say decent yield given that development costs are more expensive and this 32 million doesn't require additional funding. It will be paid by proceeds from capital raising last year. And the second point, which brings us back to the question, the impact on top line as well as distributable income to our shareholders is largely mitigated. The work at 15 Tyson Drive is progressive and will start contribution in the second half of this year. While the work at 7 Clementi Loop takes 9 months. If you look at its contribution to the top line, it's less than 1 million, which could be offset by the contribution from 15 Tyson, non-rental income from solar panels, and high reversions. So maybe just remind our audience again that the revenue growth in first quarter was 5.6% Q-on-Q and 9.7% year-on-year. It's the highest among my coverage. So we think there is definitely room for rental income growth to mitigate the impact from downtime.
Right. So I think it's worth looking at this stock audience at this time, especially as you know you have quite a bit of fear in the market, so you will have some rotation towards more higher yielding names like the REITs. So AIMS APAC, probably one of the names to look at. Jelin, I also saw that Maple Pan Asia Commercial Trust also reported results. Very briefly, can you give us the key highlights there?
Yeah, sure. So we have a hold rating for MPACT. Both top line and DPU are in line with our estimates. Revenue is mostly stable. Marginal dip was led by Forex headwinds, but DPU is lower both Q-on-Q and year-on-year. What we observed this quarter is that borrowing cost was really hurting its distributable income. But we also note that management recognized that and is actively exploring other financing options such as panel bonds or swaps to bring the cost of debt down to 3 or sub-3 levels. So on the flip side, MPACT could benefit from its floating rate exposure in a declining interest scenario.
Okay, got it. I know Krishna is also around, so I want to bring Krishna onto the screen. You know, as I said, I think the Singapore REITs particularly has been not been a great performer as a sector for most of the years for very obvious reasons. But I think as we get closer to these interest rate cuts and so on, I want to make sure our audience is very updated on the latest on the street sector. So Krishna, you know, we are kind of coming to the tail end of S3's results season. You know, what have been your key highlights and takeaways on the sector so far?
Thank you, Thilan. Thank you very much for having me. So on the REIT results itself, not much of surprise there. Overall DPU, if you see on quarter-on-quarter, half and half or year-on-year basis, that has been down from close to mid-single digit to mid-teens kind of a range. There are a few one-offs there, like say lack of non-distribution of FX gains, which were there in the prior reporting period, and to some extent seasonality as well, for example, for the hospitality sector. But by and large, it's a narrative that has been expected by us. Basically, the operational resilience has been eroded by the financing cost and the adverse FX headwinds.
Okay, so as rates start to come off, is that something that you are looking to see some delta in?
Yeah, it's an interesting juncture that we are in right now. And I think the rate cuts that we have always highlighted in the last note that we mentioned about upside volatility. So we got a bit of a tongue-in-cheek comment from one of the investors. There is more volatility than upside for me. What is there? So what we think, we are still sticking with our call of upside volatility. We think that what investors now need to focus on is what are the reasons that will drive the rate cuts. Is it a slower rate of inflation without sacrificing much of the growth? or is it a deflationary shock that kind of permeates the broader economic environment? So if it is, and we are hopeful that it is more of the former than the latter, then we think REITs are in a better shape in the near to medium term. So
Got
we
it.
are picks. We are sticking with the liquid large caps now. We have a domestic bias. Our top picks are Capital and Ascendus, CLAR, Capital Integrated Commercial Trust, CICT, and Fraser Centrepoint Trust, FCT. We tactically upgraded MAPLETREE Logistics Trust on SGD JPY call that JPY will appreciate against SGD. So far, we have seen a 10% appreciation. So we hope that for MLT, the FX headwinds will be relatively lesser in the subsequent reporting quarters. So those are the top picks and our reasons for that.
Got it. Thanks, Krishna. So yes, audience, I think it's important to keep an eye on this sector as the interest rate cycle develops. Now, let's move to another stock which was hit by a little bit of turbulence with the first quarter FY25 results. Singapore Airlines, which has a March year end, and we got Eric on the show. Eric, you've lowered your target price to Sing dollars 655 from $7.10, and you're actually keeping your hold call on the stock. Can you catch us up on what some of the key points are in terms of results and what's kind of driving your hold call at this stage?
Hi, okay. Hi, Dian. Thanks for having me today. Maybe just a recap, SIA reported first Q FY25 net profit of 452 million, which was down 38% year-on-year and 21% quarter-on-quarter. So this set of results missed our and market expectation at almost 23% and 22% of MIBG and consensus full year estimate respectively. Operating profit also fell 38% year-on-year to 470 million, largely due to lower passenger and cargo use, as well as an increase in net fuel costs. So overall, we have cut our FY25 to FY27 forecast by 15% in order to factor in more conservative yield assumption and higher OPEX, but partly offset by lower tax expenses. So in effect, this reduces our target price to $6.55, now pegged at 1.25 price to book.
Right. Now, SIA has, come up with some strategic initiatives, right?
Right.
I mean, maybe they could help in the medium term. Can you tell us what some of these initiatives are, and do you think they will move the needle?
Okay. So in July this year, SIA and Garuda Indonesia has received the Competition and Consumer Commission of Singapore approval for their commercial joint venture PACT. This basically paved the way for a deeper strategic alliance that may include JV sharing flights between Singapore and Indonesia, coordinated flight schedule in order to offer travelers more options and more seamless connectivity between the two countries. So going forward, management said that it will continue to pursue a deeper win-win commercial partnership with other like-minded carriers, particularly in these fast-growing markets within the Asia-Pacific regions. And meanwhile, the proposed merger of Air India and Vistara remains on track to complete sometime in this financial year, FY25. We understand that the transaction is still subject to India foreign direct investment approval. So when completed, the merger will give SIA a 25% stake in the enlarged Air India group, with a significant presence in the key segments of the India airline market. We think that this strategic move will probably help to bolster the group presence in India and maintain its direct involvement in this large and rapidly growing aviation market there. Yeah.
Okay, so there is some potential levers that are yet to be pulled. Now, a very important audience, on the 12th of August, we actually have Singapore Airlines CFO who will be here for a live person event at MIBG's offices. It's a very exclusive invite-only event, so please do join us and speak to your salesperson if you'd like to get an invite. Now, Eric, while I have you here, if as an analyst, what are some of the things that you'd be asking the CFO when you meet her?
Yeah, so basically we note that SIA mentioned in its outlook statement that the demand for travel is expected to stay healthy in the next coming months. But on the other hand, we also know that competition is heating up, especially from other regional airlines. So I think we need to know how SIA intends to differentiate itself and mitigate the use from falling sharply as more capacity enters the market. And maybe the next urgent question is that, with Middle East conflict looking to escalate further, how is SIA going to cope with the potential rising fuel costs, and would there be any changes to its hedging strategy? Yep.
Got it. Those are great questions. So do join us, audience, for this exclusive event on the 12th of August. Thanks, Eric. Let's quickly move on to the technicals. We've got a technical analyst looking at a trading buy on Frasers Logistics Trust. I think, again, quite appropriate at this time with interest rates today. A few big events coming up this month. Quite a few results. CSE Global, one of Opportunity Plus stocks, will be out tomorrow, as well as Sembcorp Industries out tomorrow as well. DBS reporting on the 7th, and Dynamac also on the 6th of August as well. We have Singapore Exchange results on the 8th of August. So we will be covering all these names throughout the week. So do keep an eye out for our research, as well as we'll be covering them during our Market Mondays broadcast as well. In terms of events, we got, as I mentioned, the Singapore Airlines live event on the 12th of August. We've also got a live event on Kim Heng Limited, where we will have the CEO on the 15th of August. And also do join us at the SGX for a very exclusive small cap discussion on the 22nd of August. We will have Jarek, our small cap analyst, as well as me, as well as another guest invitee, speaking about the outlook for the second half, as well as some of the key small cap picks as well. With that, unfortunately, we've run out of time. Thank you so much, as always, for your support. We'll see you next Monday. And once again, I know markets are bleeding red everywhere. Do stay calm and have a profitable trading week. See you next week.